So then we can start in at 6 o'clock. Hello. We'll start. We can start, sir.
Yeah. A good evening to all the participants. It's a pleasure to be having this webinar after a short break. And now I think with the amendments which keep on coming and the recommendations, we thought it's a good time to actually reach out to you all through this webinar. And for all of those who are as a part of this Zoom session, as well as watching this entire video on the YouTube, for all of you, a very warm good evening. A couple of days back, friends, as you are aware, the GST Council met for the 50th time. Of course, that implied a little bit of celebrations, which they did towards the start of the meeting. And thereafter, there were a slew of recommendations which were made in the day-long meeting, which lasted. And I think some of them have far-reaching implications. And that's the purpose of today's webinar, to apprise you of what are the key changes which are being recommended by the GST Council, and how is it going to impact the day-to-day activities which each of you is carrying out on a regular basis. Of course, there is a little bit of a backdrop to this entire GST Council meeting. We are all aware that GST has completed 6 years since its birth. It was born on 1st July 2017 with a lot of hype, with a lot of coining of names, including a name saying GST is nothing but a good and a simple tax. As 6 years have completed, 50 GST Council meetings, numerous recommendations, clarifications, notifications, amendments, and lots of activities at each organizational level. So perhaps it's time to introspect. And the article which was published in the Mint today morning, really the headline of it, more importantly, says it all. It says that the GST, perhaps it's time for a factory reset. And in today's world of electronics and fast-moving consumer goods, we know that any product doesn't last for more than 4 or 5 years. And thereafter, either you have to replace the product or it's time for a reset. I think that's an interesting title which it has brought in. And when we go through some of the council meeting recommendations, we will find that, yes, there are certain systemic issues which we will have to deal with. Some of the aspects are positive, but there are a couple of areas where there is a scope for further improvement or a need for the so-called reset, as talked about in the Mint today. Of course, the article which talks about the reset is only from a context of 2 specific sectors, which deals with online gaming and automobiles. But I think we need to expand our horizons to much more beyond that. And that's what we'll try to do in today's session. Over the last 6 years, necessarily, from the government side, there had been anxiety about the revenue growth in the initial period. But of late, revenues have shown a consistent growth. And we are every month talking about numbers which are just increasing, defying logic to some extent, because the increase in the revenue, GST revenue, is much disproportionate as compared to the increase in the GDP growth. And essentially, when your tax rates remain more or less constant, your GST revenue is going to be a multiplier of the GDP and the GST rate. If that be the case, one is always perplexed that how does one achieve such a good GST revenue growth, in spite of there being, of course, the GDP is also growing, but not at that rate. So yes, all said and done, we are seeing a stability in the revenue, an increase in the GST revenue. And one reason why it is growing by leaps and bounds is the higher level of compliance. As compared to the earlier fractured indirect tax regime, where there was a lot of scope for people to interpret or at times even to make a fast buck. As far as GST is concerned, it's a uniform tax across the country. More importantly, because of the type of the uploads which are being done, the e-way bills, the e-invoicing, and the GSTR1 and the 3Bs which are being filed, there is a lot of content at a transactional level which is now available to the government authorities. And the government authorities have made a good use of that. They have employed some very sophisticated data analytics tools at times we are surprised to find that the government IT learning curve is much larger as compared to the private sector in many cases. They are having the most sophisticated systems and softwares which are helping them in unearthing many cases of fraud. And we are seeing that happen every month or two. We are seeing names coming up in newspapers, including some reputed names, listed companies, large industrial groups. And the department somewhere is able to pinpoint specific transactions. It's like finding a needle in a haystack. But successfully, to the credit of the department, the data analytics has helped them to unearth many cases of these types of frauds. And because of that, naturally, there is increased buoyancy because of that reason also. It's a process of cleaning up of the system, which is happening. It also has a lot of ripple effect in terms of direct tax revenues and in other compliance issues. While all of that is perfectly justifiable, because it's nobody's case that we want to really encourage frauds or encourage people making a fast buck. Having said that, what has also happened over the last 1 year is that because of the limitation period coming in, the department has become active in terms of normal, regular taxpayers also by way of department audits, investigations, inquiries, and other things. And when we look at the questions, then the approach of this department audit, many a times the question which comes is that yes, GST, with so much of data flow available to the authorities, perhaps the context has changed, but has the mindset changed? And I'll give a very simplistic example. In the pre-GST regime, in the excise regime, service tax audit regime, in the EA audit, there was a checklist. And when the SSE was selected for an audit, and most medium-sized organizations would get selected for audit, it's only a question of timing. There was a list of 40 items or 40 sets of documents and information which was being called for. And that would include, copies of returns filed, copies of tax payment challans, copies of sample copies of invoices, etc., etc., etc. The same checklist, with a little bit of amendment, of course, has continued in the GST regime. Now, the fundamental question which comes up is, they would want copies of GSTR1, but the consolidated, and along with the consolidation, tabulation, everything, but all of those data is already available on the GST portal, which results in a substantial duplication of work, and thereafter then reconciliation of those aspects. And therefore, somewhere the thought process which comes up is whether really the mindset has changed. And I think these are early days. It's only time which will tell whether the mindset is likely to change, and if it does not change, how is it going to impact the overall process in terms of the maturity of the law. And that's when you look at the GST Council meeting recommendations, as we go into the specifics, you will find that many places, the proposals are in the right direction. But if you go a little bit deeper, you'll understand that the mindset really is not changing. And that is a bit of a worrying sign, because if the mindset is not changing, you will always have to keep on doing patchwork. You'll always have to keep on clarifying. There will always be some uncertainty that trade will face, the industry will face. They will have to then represent to the council. And somewhere, of course, we've seen in many cases better sense prevails at the council. And therefore, then they will intervene and give a clarification. I don't think this is the way the law can mature. If the law has to mature, all the stakeholders in the process have to be mature enough to understand what are really the issues and what are frivolous issues. But that's where I think there is a bit of a mindset change. Before we go into the recommendations one by one, just a generic slide which will apply to all the recommendations and the other slides which we are going to talk about hereafter. Please note that GST Council has only recommendatory power. It is a council consisting of the Union Finance Minister and all the state finance ministers. And the council cannot make an amendment in the law. It can only propose an amendment in the law. And therefore, whatever is being talked about, the press release which was given day before yesterday evening, is only a recommendation. Of course, history of the last 49 meetings have shown that whatever has been recommended by the council is implemented in letter and in spirit. It's only a question of when. Sometimes the clarifications, notifications will come immediately. Sometimes it will take some days. And in most of the cases, our past experience suggests that all the recommendations may not be implemented on the same date. They may be staggered. Some of them may be implemented immediately. Some may come up slightly later. And therefore, we need to understand that whatever we are going to talk about today is something which is going to come, but we don't know when it is going to come and in what form also in some cases it is going to come. Because again, the press release is only the snippets or the bullet points. The implementation would to a large extent be based on ideally should be based on an amendment in the act or in the rules in an appropriate manner. But what we are also seeing over the last history of the 49 council meetings is that many of those amendments also get implemented through clarificatory circulars, detailed clarificatory circulars, or some notifications issued in this regard. And many a times, these clarifications or notifications do not find a place or cannot be implemented because end of the day, there is this GSTN portal. Most of the activities have to take place on the GSTN portal. And if the software is not amended to really bring in the implementation of the recommendation, till that time, necessarily you face a bit of a deadlock. And therefore, when we are going to talk of the recommendations, some of the places there will be a clarity of the date of implementation. In many of those cases, the effective date of implementation will be fairly fluid. And as things keep on progressing through our WhatsApp communications, through our newsletters, we will be outreaching to you and informing you of those changes. Depending on the materiality and the importance of the issue and the general widespread relevance, we may again repeat a session like this. We are also actively considering doing a face-to-face meeting, since it's been quite some time since we've done that. Post the pandemic, Zoom has provided a comfort zone for each of us to be in our offices and to interact with each other. But I think once in a while, a face-to-face meeting may be called for. And that's what we are planning something in August. And at this point, I would like to highlight that when we announce that dates and the venue, it would be, it would be great if all of you could join in person so that we could really interact and network also at that point of time. So the essence, what we are trying to take home from this slide is that the effective date may be fluid. And because of this fluidity of effective date, many taxpayers come back to us, many clients come back to us and say, sir, how do we implement it? Because organizations today are also equally complex. Just like the government is unable to amend its GST portal overnight and therefore defers the implementation in some cases, at the taxpayers end also there are complex systems. Gone are the days where a person will just have a small tally or some basic accounting software. Today, ERPs are complex. There are native softwares which deal with the invoicing, and there are integrations between those native softwares and the ERPs. And therefore, if there has to be some change, it also needs a change request at the organization end. There are dependencies within the organization with the IT teams, with the contracting teams, the supply chain teams, etc. At the same time, there is some of the examples which we will be talking about. There is also a need for a stakeholder education. And when I was looking at some of the amendments and we were talking internally yesterday, we were saying that, yes, it is a sort of a mini implementation which is going to come up, like what was the phase of 16-17. Some of the proposals are so far reaching that you will have a challenge in implementation, and some of that may even require, if brought in the way it is being proposed, it may also require an overhauling of your entire tax positions. And that's where I think it may be important to really look at how we are going to deal with these things. So with that background, we go straight into the proposed changes or recommendations in the GST Council meeting. And very quickly, we'll just talk about some changes in the tax rates. Of late, what we've seen is there has been a reasonable stability in the tax rates. Gone are the days of an abnormally high rate of taxation. Most of the products and services bear a general revenue neutral rate of 18%. Very few items continue in 28%. And then there are concessional tax rates of 5% and 12% respectively. Of course, certain products are given, products and services are given exemption, but more and more we are finding that the idea is to widen the tax base, and therefore the scope of the exemptions or the nil rated entries are reducing. Now, while all of this is happening, and while the idea in this council meeting was merely not to touch too much about the tax rates, except a particular sector which we'll be talking about, which is about the online gaming. What had happened was, in the past, because of the dependence on the classification schedule, there have been disputes about the correct interpretation of the tax rate, and any tax law will face that type of a challenge. And when taxpayers approach the advance authorities, there is a challenge that there could be conflicting advance rulings on the interpretation of the particular tax rate. And therefore, in certain cases where those types of controversies arise, GST Council regularly steps in. The rate committee, there's a special rate committee which has been set up as a subcommittee of the GST Council, which examines the various tax rates on the products and representations in this regard, and then makes recommendations. And based on those recommendations, the GST Council thereafter considers those recommendations and proposes whether those recommendations should be implemented or not. So that is, in that situation, we are seeing that in a few cases, the government is either trying to clarify or make suitable amendments also, so that the rate is clearly identified and the disputes are reduced to the extent possible. The intention is really good. And I think this entire thing started with a very simplistic example of an ice cream parlor. We are aware of a couple of years back, there was a debate on whether an ice cream parlor constitutes a restaurant and therefore liable for 5% tax, or whether it constitutes a sale, in terms of a shop, like a sweet shop, and is it liable for 18% tax. Interestingly, the industry was divided. Most of them wanted an 18% tax rate because the 18% tax rate came with eligibility for input tax credit. Whereas some people wanted a 5% tax rate. Matters went to the advance ruling authorities. Advance ruling authorities treated ice cream parlors as restaurants. There were conflicting advance rulings treating them as a shop also. And therefore, there was a confusion. So somewhere in 2020, clarification was issued at a GST Council meeting, treating the ice cream parlors as shops and therefore liable for 18% with input tax credit. Now, of course, when it comes up in this fashion, there's always a challenge that because the circular is clarificatory in nature, what happens to the past period? And therefore, once again, a second round of representation went to the government. And in a subsequent GST Council meeting, the council said that what we will do is, we understand that up to a particular date, when we clarified 18, there was a confusion, a genuine confusion in the industry that it could be 5, it could be 18. Some people did 5, some did 18. Now, if we keep on fighting, yes, there will be the matter will have to be tested legally in the courts of law. But that is a long 20-year process. We don't want that type of a litigation. So therefore, there was a clarification in a subsequent GST Council meeting that, okay, for the period prior to this clarification that it will become 18%, we will accept whatever the ice cream parlor has done. If they have paid 5% without ITC, we will accept it. If they have done 18% with ITC, we will accept it. And this is what perhaps brought in this thought process called as is basis. And if you look at this recommendations of this GST Council, you will find that there are many situations wherein the council is saying that, okay, from a prospective date, we are telling you that this is going to be the rate. For the past period, we will respect whatever you have done. So for the past period, it will work on an as-is basis. On the face of it, I'm sure most of you will feel that this is really a positive step because it reduces litigation. It reduces a lot of uncertainty. It reduces the requirement of payments of pre-deposits for the past period. And therefore, one would really feel that this is really a proactive government trying to bring in this type of a concept. And the intentions clearly are good. However, the challenge which as a tax implementer, I see when I talk to clients and the client's reactions on these types of issues is slightly different. Now come to think of it. There will always be some controversy or the other in the law. And whenever that controversy comes up, before it matures to the level to reach a GST Council, it reaches the attention of GST Council, a lot of water has flown before that. It will start with some authorities saying that these are the reasons why we believe it's 5. The industry is also doing 5. We also believe it's 5. We've collected 5. You paid 5. Now you are telling me 18. How do I go about doing it? Now,
It's a will.
Sorry, I think I got dropped out for a minute. So when the taxpayers or auditees face this type of an issue, which has germinated at a ground level, and that happens across the country, all the auditees in the industry will face these types of issues. But the response of each auditee will be different. Some auditees will say, I don't have the courage to litigate. I will pay up for the past period and I want to amend and move in my life in a simple manner. Another set of guys will say, okay, let me litigate this for the past period. For the future, I will amend the position. And there will be a set of people who will want to litigate throughout. Now, when you have these three sets of people, and when more and more situations of as-is basis happens, the message which you are passing to the industry is, please litigate. Because if you end up paying, you are not going to get a refund of it at all. We have the celebrated ITC decision in the context of excise, where once the tax is paid, it is gone. And therefore, having a bit of a patience, having a bit of a courageous or a litigative attitude may perhaps serve well in case the as-is basis type of a situation is going to happen. And if this is happening repeatedly, necessarily, I think somewhere the message which goes is slightly different. And that's where I think what needs to be done is that this as-is basis has to be done with a little bit of a caution. You cannot make it as generic thing that everything we will start doing as-is basis, because then there's nothing like a law. You are saying whenever there's a debate, those people, X can do something, Y can do something. After 2 years, we will clarify. And we will clarify that as for the past period, we are regularizing things on an as-is basis. So that is a bit of a challenge on a long-term maturity of a law, which I could see. Having said that, of course, I'm sure by the time I'm talking about all of this, you would have gone through the slide and looked at the important products where the tax rate has been sought to be clarified. I think a couple of things which we will talk about is the compensation cess on utility vehicles. And this cess has been, again, this is a dispute which was there. The laws provided for a compensation cess on an SUV at the rate of 22%, subject to certain conditions relating to the length of the vehicle, relating to the ground clearance. And more importantly, sports utility vehicle, SUV itself was not defined. And in that context, there were investigations which were being carried out. And what this GST Council tries to do is it tries to define exactly how the length will be calculated and how the ground clearance, which will be calculated, which will be based on the unladen capacity of the vehicle. So those conditions have been streamlined and clarified. We are also told that sports utility vehicle basis, sports S is being removed, and therefore all utility vehicles, if they satisfy these conditions, will be liable for the compensation cess at the rate which has been mentioned. So in that sense, there, of course, there's the delta is 2% compensation cess. It makes an impact, but I think it's for a very specific sector and something which has come up on that front. Otherwise, we are seeing many places where the tax rates have been defined and an as-is basis has been provided for the said purpose. A couple of more important things is the situation of F&B sales in a cinema theater. And we are told that this will now be treated as restaurants. In our view, it was always to be treated as a restaurant, but well, maybe there has been some dispute or some issues around that. And therefore, it has been clarified that it will be treated to be a restaurant service liable for 5% without input tax credit. The caveat is that if the restaurant is bundled as a part of a cinema ticket, and we are aware of schemes which many cinema chains bring up, that when you book the ticket, you can say that, okay, I want to pay X rupees, and within that X rupees, a popcorn or a drink has been built into it. If that be the case, naturally, the ticket rate, because it becomes a part of a composite supply, the principal supply would be the exhibition of the cinematographic film, and therefore the rate for the exhibition of cinematographic film or the ticket is what will be applicable to that composite supply. So subject to that, if it's a divisible and a separate supply, clearly we are now told that it is going to be treated as a restaurant with 5% and no input tax credit. That takes me to the much talked about situation, which really deals with the taxation of casinos, online gaming, and horse racing. At a personal level, I've never been involved into these types of activities, and definitely from a government perspective also do not want to encourage it too much, and that comes out from the proposed rate of 28%. And it's not only just a rate of 28%. What has also been mentioned is that the entire value of chips or bets will become taxable. So the valuation itself creates a bit of a challenge, because essentially, as we all know, in all of these activities, there's a participative process. Out of the entire value of the chips, a substantial part of it is paid out by way of winnings or prize monies. And so therefore, if let's say chips of 100 rupees are sold or given to the participants, maybe on an average, they would be giving out prizes of 95, 96 rupees. And if that be the case, you are bringing in a tax rate of 28%, necessarily there's going to be a bit of a challenge in the industry, and there's a lot of discussion which is going around on this front. On the legal part also, there has been a bit of a challenge. There has been a fair share of litigation on this front. There was a substantially large value show cause notice issued to an entity called Gamescraft, and it reached a lot of gossip in the newspapers as well. And thereafter, of course, that notice was challenged in a writ petition in the Karnataka High Court. And the Karnataka High Court went ahead and analyzed the concept of games of skill versus the games of chance. And they said that all these activities, that example specifically was in the context of online gaming, which was a rummy, online rummy, which is being played. And the Karnataka High Court said that, look, I believe that this is a game of skill. And being a game of skill, the amounts which are being transacted become actionable claims, and actionable claims are excluded from the purview of GST. So there is a legal impediment to this. Necessarily, they will have to amend the Schedule 3, which deals with an exclusion for actionable claims, subject to gambling and betting being out of it. So they will have to make a suitable amendment to Schedule 3 and thereafter implement this entire tax of 28%. I am also aware that there will be a lot of representations on this aspect of the taxability on the entire value chain. But I believe that something like that also happens in case of lotteries. And therefore, I'm not very hopeful about how it will turn out in terms of the constitutional challenge. We'll just have to see how it goes ahead. But yes, this is one important proposal which has been recommended by the GST Council meeting. That takes me to the changes or clarifications relating to reverse charge mechanism. And the first clarification is relating to a supply of raw cotton by agriculturists to cooperatives. And there was an interpretation of whether this is a subject matter of reverse charge, meaning whether the cooperative will pay the GST on purchase of raw cotton, or whether the agriculturist himself is required to pay the tax, considering also the fact that agriculturist has been excluded from the purview of registrable entities. And that is where the issue was raked in the past. And therefore, we are now clarifying or recommending that, yes, through a clarification, we are saying that the cooperative will be required to pay the GST on reverse charge basis. For the past period, again, the as-is basis is being suggested, meaning if somebody has not paid and the agriculturist has paid, then we will regularize that and we will not question the conduct for the past period. The second thing is something, again, where I feel that a sort of a mid-term thought process needs to be defined. When in 2017, we started with the concept of reverse charge mechanism for GTA. Of course, service tax GTA reverse charge has been there throughout. And even in GST, from the day of implementation of GST, GTA services have been under the reverse charge mechanism at the rate of 5%. And based on representations, many transport agencies felt that we want to collect the tax and pay, more importantly, from a perspective of maintaining the credit chain, because they would have inputs wherein there would be input credits available. And therefore, based on the representations, there was a mid-term amendment in the entry, whereby the GTA was given a choice. Either they can pay tax under forward charge at the rate of 12% with input tax credit, or they can issue a reverse charge declaration and the consignee or the payer of the freight would pay the tax under RCM. Now, that condition, there was a condition in that choice that whichever choice a GTA chooses, he will apply that choice henceforth, meaning that the GTA cannot pick and choose one transaction to be under RCM, one transaction to be under forward charge. Now, at that time, things were going well, and there was a bit of confusion that how does one change this process and all those things. So just last year, the notification was amended to require a GTA to file a declaration for forward charge. If no declaration is filed, it would be treated as reverse charge. And the law said that you have to file this declaration at the start of each year. Now, just last year, this amendment has been done. And this year, now we are told, and better sense to some extent has prevailed. We are now told, what's the fun of asking the GTA to file an annual declaration every year? If he has filed it once, we will continue that declaration till the time it is withdrawn. So now the declaration becomes a one-time process and it need not be done every year. Only when you want to move from forward charge and stop the forward charge and go back to reverse charge, you file a declaration that it is I want to withdraw the the option of forward charge. So in that sense, a good or a better sense has prevailed, I would say. Unnecessary paperwork was involved, which has been reduced. Just stepping back a bit, just like there's a declaration for a GTA, there is also a declaration called letter of undertaking, which all exporters or suppliers to SEZ units have to file. Now, again, it's an online process. 2 witnesses required, just a document which has to be filed online. And unless that document is filed, you do not get the benefit of an upfront exemption from payment of tax. My suggestion to the government would be that they need to be proactive there also. And perhaps there also they could say that once an LUT is filed, it will continue and it need not be a financial year wise filing of an LUT. That LUT can continue for periods up to which the person says that no, now I don't want to export and I want to withdraw from the LUT concept. So I think that is something for the government to think through. As of now, it is not there. Any of you, if you have not filed the LUT for the current financial year and you are planning exports or undertaking some exports, please make sure that you get the LUT filed at the earliest. I am sure most of you would have done it and our teams would have guided you to get it done. But if they are due to various activities, if you have missed it out, I think it's better to get it done at the earliest. The third clarification, and this is an issue which was haunting right from the service tax law, was a situation where services are given by a director to a company. And there is an entry which says that sitting fees paid by, is an example which we are talking about. And we are told that services given by a director to a company will be under reverse charge mechanism. To start with, the debate was whether this entry will cover only directors who are non-employees or employees. And we had a fair share of litigation on that. And we are now settled to say that it does not apply to employee directors because they receive salaries, which is excluded from the scope of taxation itself. But if he is an independent director, in that case, he is not an employee of the company. He renders services to the company, receives sitting fees, and the company is required to pay GST under RCM on such sitting fees. And most of the organizations implemented it. The challenge which came up was many superintendents at the ground level, when they did audit, they said that, look, this director is getting sitting fees, but at the same time, he's also giving a property on rent to the company. And many a times we see those types of situations happening, especially if it's a promoter director or examples like that, family members. You find that they would be giving different types of other services in their personal capacity. Somebody might be giving a professional service. Somebody might be giving a renting service. Different types of activities may be carried out by a director, not in his capacity as a director, but in his capacity as a normal contracting individual. And the department wanted to say that moment you become a director, then that director umbrella is so wide that any and every payment made by a company to a director goes under reverse charge. And most of the directors did not take that type of a position, and it is illogical to take that type of a position. For example, if a chartered accountant is an independent director and he renders certain services to the company also, for the services which the firm renders, proprietary firm renders to the company, the person is going to charge GST. It can't be a reverse charge mechanism, and matters were pending in the courts on this point. So here again, there is a clarification to say that the RCM entry will cover only situations where services are rendered by the company, by the director to the company in his capacity as a director of the company. If he's rendering some services in his personal capacity, then it will be a subject matter of forward charge, and the director will collect the tax from the company and pay it to the government. So I think that's a welcome clarification once again. And in that sense, it's a positive thing. A few more positive aspects, which of course comes under the heading of trade facilitation measures. The idea is that we want to maintain continuity. So there are a couple of amendments in this regard. The first is regarding the annual returns for financial year 22-23. As we are aware, annual return has 2 parts to it. The annual return by itself is in GSTR 9. And if your turnover crosses 5 crores, then there's another reconciliation statement to be attached with the annual return, which is known as GSTR 9C. The annual returns have to be filed by the December of the financial year. So for financial year 22-23, you will have 31st December as the cutoff date for filing the annual returns. Our experiences over the last few years are that the government is not happy to extend the dates, and therefore towards the last moment there's a lot of pressure coming up. Our teams would reach out to you wherever we are involved in the process of processing the annual returns for you, and we would want to take it up at the earliest opportunity so that we are able to meet the deadlines in time. Now, for financial year 22-23, we are told that just in the earlier years, there's certain relaxation in reporting was given in the annual return, GSTR 9. Some tables can be partially filled, some tables may not be filled. So all those relaxations which were given in the earlier period continues in the current period as well. So essentially, the continuity of the way in which you are going to do the annual return process will continue, meaning whatever you have done for financial year 21-22, same process we will continue for 22-23. Therefore, definitely it's a welcome step. The second one is again a very welcome step, I would say. And the first step started with the Maharashtra state government issuing an internal circular, which was as a best practice issued by the Maharashtra state government, and we should applaud them for that. The state government circular was suitably modified by the GST Council, and thereafter a circular was issued at a pan-India level, which is the circular 183. Many of us are aware of this. And the issue which was arising was relating to mismatch in ITC, difference between GSTR 2A and 3B figures. And as we are aware, for the initial years, the law had no specific provision, or the act did not contain a specific provision for matching. However, there was a requirement that the tax should have been received by the government. If the tax has not been paid by the vendor, then the recipient cannot claim the credit, one of the conditions of section 16. So for financial year 17-18 and 18-19, circular 183 came out with a clarification to say that, okay, if there are transactions where a company has paid a tax to his vendor, the vendor has paid the tax to the government, but for whatever reasons, the tax is not uploaded in GSTR 1, or it's uploaded in the B2C section, and or in some other person's GST number, and therefore it does not reflect in your GSTR 2A, then you can get a certificate from the vendor that the tax has been paid. And there was a cutoff of 5 lakhs. Up to 5 lakhs, you can get a certificate from the vendor. If it's above 5 lakhs, you have to get a certificate from the vendor's CA, certified by the chartered accountant of the vendor. So that clarity was given, and this was helpful because in many of the cases where there was a difference and reconciliations were done, and we found examples of mismatches. For these mismatches, you could have gone back to your vendors, and many of them would comply and give you that document, and based on that document, the demands were getting dropped. Now, while that circular talked about only 2 financial years, the recommendation of the GST Council this time is that we will continue this process of certification up to 31st December 2021. Now, this is a very important cutoff date. Why are we saying 31st December 2021? Because from 1st January 2022, one more condition has been brought in section 16.2 itself, which says that you just can't claim the credit. Your claim of credit itself, the first point of claiming the credit is dependent on the transaction coming in your 2A. Therefore, necessarily for the period prior to that, wherever there was a dispute, this circular helps you, and you can obtain the certificates even if, let's say, the audit has not begun or the queries have not started. Proactively, you may like to look at the mismatches for all the years and obtain the certificate from the vendors, because today you might have a good relation with the vendor. There might be continuous business dealings. So the vendor would be happy to give you those types of certificates. But if as time progresses, memories start fading, and at that point of time, let's say the vendor is not available or your relationships are not so good with them, then they may resist giving this type of a certificate, and then you might have a demand. So therefore, I think again, a very welcome step that we are continuing that thought process that a certificate could be fine for a mismatch. So long as the tax has been paid, credit should be available to the recipient. Make no mistake, I'll repeat it once again, from 1st January 2022, all of this does not work. It is important that the tax comes in your GSTR 2A. And that's where we also see that most of the large organizations have started retaining whenever an invoice is presented to the company. They start retaining the GST component. They wait for the GST to come into their GSTR 2B, and only after matching they release the GST component. And wherever possible, I would recommend that yes, organizations should start doing that, because otherwise there is always that risk of that tax not being available to you as a credit. Last couple of GST Council meetings back, an amnesty was declared for late filing of various types of documents, and that amnesty scheme was expired on 30th of June. This GST Council has taken a decision to extend that amnesty up to 31st of August 2023. The amnesty pertains to GSTR 4, GSTR 9, and GSTR 10. So all these three returns, if they have been filed late up to this date, then naturally there is a amnesty from the late fees. So again, please make best use of it if you are stuck up with something. Now, of course, with that background, we go into some conceptual issues and some substantive issues relating to tax on outputs and input tax credit. On the supply side, we have a very interesting clarification, and perhaps this is what I was referring to when I started my preamble, to say that there's a mindset issue. And here, this has again started in one specific sector, one specific jurisdiction, which is Karnataka, and then slowly it transmitted to Andhra Pradesh and Telangana also. And so what happened in those situations was the authorities tried to look at the HSN classification which has been given. And the classification of services has one entry which says services by way of holding securities by holding companies in subsidiary companies. Now, based on this entry, notices were issued to all companies saying that, look, if your holding company is outside India and there is, you are a subsidiary of that holding company, we believe that this entry says that holding company has provided you a service by way of holding securities of yours. And because you are not paid them anything, and because both of you are related parties, there is a notional valuation which tricks in, and you are required to pay GST under RCM. Of course, the matter was pending in the court and better sense prevailed, and this GST Council, we are now clarifying that merely holding securities in subsidiary is not a service. Come to think about it, I might be holding shares in one company. Does it mean that I am giving a service to the company? I might have invested in that company directly. It could also be possible that I have bought the shares from somebody else in the market. The company, yes, of course, it will change the name of the shareholder in the records. But beyond that, I have no direct interaction with the company. And where's the question of providing any service? And I think the better sense has prevailed, and we are now told that holding securities in subsidiary is not a service and therefore not taxable. My only concern in these types of situations is, if you really look at it, it's a frivolous type of a point. And there were people who faced sleepless night on account of this. Perhaps I think a little bit of more education, a little bit of more stakeholder consultation at a ground level might be required, because otherwise, whatever be the best intentions of the authorities at the GST Council and at the ministerial level, if it is not implemented well, there is always going to be challenges. And therefore, I think a bit of when we interact with various authorities, we find many a times some basic fundamental points are not very clear. The basic distinction between goods or services. Sometimes either there is a bit of a inflexibility in understanding all of that. And I think that is one area, a pain point, which needs to be addressed as time progresses. Now comes the second one, which is again an interesting point. Last couple of rounds, this has happened. And again, if you look at the root cause of this entire thing, is a challenge that the GST law does not permit revision of returns. And therefore, if somebody makes mistakes, those mistakes can be corrected only in a subsequent filing. And this becomes a root cause of various types of mismatches, apparent mismatches. I would not say correct mismatch, but an apparent mismatch. For example, I might have filed a GSTR1 for a particular month. In my GSTR1, my B2C transactions are to be reported at 10 lakhs. But by mistake, I report it as 5 lakhs. Now, the GSTR1 is filed on 11th. On 20th, I realized that, okay, it was not 5 lakhs, it was 10 lakhs. So in GSTR3B, I plot the correct 10 lakh figure and I pay tax on this 10 lakhs. So far, so good. My one was showing 5 lakhs, 3B is showing 10 lakhs. I paid tax on 10 lakhs. but my reporting in GSTR1 is incorrect. Because I can't rectify the GSTR1 or revise the GSTR1 for that month, what the law provides is, and the circular provides is, in the next month, I will disclose B2C of GSTR1 by increase it by 5 lakhs. So next month, if I have only 2 lakhs of GST B2C, I will show instead of 2 lakhs, I will show 7 lakhs. So in totality for both the months, my amounts will match. In the next month, while I will show 7 lakhs there, I will pay tax only on 2 lakhs because for that month, my 3B, the actual B2C is only 2 lakhs. So when I total these 2 months, my 1 will match with 3B. But if I slice and only look at the next month, second month, you will find that 1 shows 7 lakhs and 3B shows 2 lakhs. First month, the government is not worried because they feel that you are paying more tax. They are not worried too much. But when it comes to the second month, immediately the portal starts creating problem. It starts saying that, look, you have not paid taxes correctly. And therefore, recently we have started a process called DRC 1B, wherein in DRC 1B, a notice will be given to you that, look, I can see your GSTR 1 to be 7 lakhs. I can see your GSTR 3B to be 2 lakhs. So please explain why is there a gap? And then they've given you 4 reasons and you can pick up one of those reasons. Based on your reason, if they find it satisfactory, it is fine. But if they don't find your reason to be satisfactory, then they will start recovery under a document called DRC 1D. So this is what has been recommended in the current GST Council meeting. That takes us to the next apparent mismatch, and which is basically the old talked about mismatch, 3A, 3B versus 2B mismatch. And here, again, the thought process is that if your 3B is higher than 2B by beyond a particular threshold, in that case, they will issue you a notice in DRC 1C. Again, the problem is, especially in this case, the problem is much more compounded because you cannot claim the ITC until you have really accounted for the invoice, booked the invoice in your books, and accepted the transaction. Now, all of that may need some time. In many organizations, the approval process itself might take 1 month, 2 months. Many a times for miscellaneous items, you don't really book the invoice as and when it comes. You only book the entry as and when you make the payments. Now, in all those types of situations, you will end up with definitely a situation where you will claim 3B in a subsequent month for a transaction which was appearing in a prior month. Now, when you are bringing this type of an apparent ITC mismatch, you are actually increasing the paperwork, not realizing or ignoring the fact that this is something which is fundamental to the way the GST system is implemented. And therefore, I would believe that rather than having a monthly or a periodic ITC mismatch, ideally, this type of a document should have been a part of your GSTR 9. At an annual level, one can just look at an overall matching, and there you already have a table in GSTR 9. Maybe that could have been made a little bit more clearer or a better version in terms of the data to be collated. And maybe that would have helped. But rather than that, we are increasing a little bit of paperwork by assuming that every difference is an apparent mismatch. And then the taxpayer is expected to respond within a particular timeline. Now, these notices come on the portal. If he does not look at the notices, then they will say it has become time barred, and then they will raise demand notices. And then you have to keep on litigating those matters. So I think that is something which adds to a little bit of, touch points or interaction points with the departmental authorities. The next is again a welcome clarification. There has been a debate around the tax treatment of spare parts which are replaced during a warranty period. So if I'm selling a machine, along with the sale of the machine, I provide a 1-year warranty. And within that warranty, if the parts have to be replaced, different authorities have taken different views. Some authorities have said that the replacement of the part, you are required to pay tax as a sale, even though you have not received any money. Some authorities have said that, look, I agree that it is not a sale. There is no money you are receiving, but I want to treat it as a free supply. And there is a blocked credit concept, which says that if you are supplying something free, then you are not eligible for input tax credit. So both the types of issues were being raised up at a field formation, and sense has prevailed. And the GST Council says that, look, essentially, the price of the parts supplied during a warranty are included in the base price of the machinery itself. And therefore, there is no question of any payment of output tax. And at the same time, it's not correct to say that the warranty replacement is nothing but a free part. It is not really a free part. And therefore, there is no requirement of reversal of any input tax credit also. So this is a welcome clarification which has come in on this front. On the matching concept, we are now told that the refund of accumulated ITC will be restricted to the extent of matched ITC, matched credits only. I understand this was already implemented through circulars and through the portal mechanism. This is again revalidating that thought process that unless your ITC is matched and unless the government has received the tax, they are not going to give you credits, they're not going to give you refunds. The next one is again an interesting thing. We are told that if there is a duty-free shop which is selling goods to an incoming passenger, necessarily there is no tax because it becomes a part of Schedule 3. The sale is happening because the goods, before the goods reach the Indian frontier, because they are within a bonded warehouse. But last year we had an amendment to say that these items will be zero rated and there will be no requirement for reversal of credit. Now we are to recommend, there's a recommendation that supply by a duty-free shop will become a part of the exempted value for ITC reversal. So input credit will not be available to such duty-free shops of the inputs which are being used for the making the supplies. And finally, this is one more aspect which, in again, a welcome change. And this was an issue which was coming up last year. We had an amendment in section 50, and all of this happens in piecemeal. We had a situation where there was a question that if I have availed input tax credit, but I have not utilized it, and I reverse that credit, whether I'm required to pay interest. The taxpayer used to argue that, look, I have not deprived the revenue of any money. And based on the out-of-pocket theory, Reflex Industries took a view that interest is applicable only on utilization. At the first tranche, GST Council accepted this thought process, and therefore Section 50 was amended. And then we had Rule 88C, which said that interest is payable only if the ITC is utilized. Just because you have availed and kept it in your electronic credit ledger, you don't need to pay interest. And thereafter, we have a rule which operationalized this thing to say that, okay, we will look at the point when the maximum ITC is there, and then accordingly, we will calculate. And that all those things, we are aware of this process. The challenge which was coming was, we have 3 flavors of ITC, or rather 4 flavors of ITC. We have CGST, SGST, and IGST. And then there will be cess also in some cases. One more provision says that even if you have availed ITC of IGST and your output is CGST and SGST, you will have to first utilize all your IGST before you can utilize CGST, SGST. And therefore, effectively, most organizations will have accumulated credit balance, but those credit balances will lie in CGST and SGST ledger, not in the IGST ledger. And therefore, the debate which was coming was, I may have 50 crores in CGST, SGST. My wrong availment of ITC, which I want to reverse, is only 1 crore. Should I pay interest? But that 1 crore is about IGST. And that's where this GST Council says that we will look at interest availment utilization on the basis of aggregate of all these numbers. We will not go into saying, okay, IGST, your balance was 0, so you please pay interest on that. CGST, SGST, you have extra balance, keep it as it is. No, that's not how it should be interpreted, and the GST Council better sense has prevailed, and they have said interest will be payable only if you have utilized the credit on an aggregate basis. Total column karo, total column ke upar hi compare karo. That is what the GST Council recommendation tries to say. And I think this is the most important and the long-lasting facet of the amendments which we need to bear in mind. And this is something which bothered us ever since the implementation of GST. The old service tax law had a provision of input service distributor, which was optional. If you have an head office and you have a factory in another location, you may obtain an ISD registration and distribute the credit to the factories where they can use it against excise. So that was there under the old regime. So that old regime provisions were transitioned into GST. At the same time, we had entry 2 of Schedule 1, which talked about branch transfer of goods as well as branch transfer of services. So if you have 2 GST registrations, and if one GST registration is giving some service to another one, then entry 2 of schedule 1 would force a cross charge or force a tax to be charged on that transaction, and which, though there's no word like cross charge, industry started understanding it as a cross charge. And again, at that point of time, based on interactions with the authorities and the general concept of the way the GST law was drafted, one felt that both ISD and cross charge are provisions which permit a balancing of input credit because of the fractured GST regime. Your GST regime requires a state level registration. Your inputs and output taxes input tax credits and output tax payable may be in different states. And therefore, you might end up with huge credits in one state and huge output tax in another state. And therefore, it was understood that both ISD and cross charge are mechanisms to bridge this imbalance. Having said that, many cases this imbalance may not arise because of value addition and other reasons. And at the time of implementation, there was always this conundrum. Whether we need to do ISD, whether we need to do cross charge, whether both needs to be done, or whether both are optional. Now, if we look at the clarifications issued around that time, most of the clarifications said ISD is not mandatory. And cross charge, yes, if there are discernible services, you may require to do a cross charge. But there was also a proviso to Rule 28, which said that the value which you are going to plot on your invoice will be acceptable. And therefore, in implementation, especially in most of our clients, in many other cases also, organizations have chosen the route of cross charge rather than ISD. They have said, we will do cross charge. We will not do ISD. Wherever we find that there are common credits coming at the head office, that also will become a part of the cross charge mechanism, and we will distribute it through cross charge. While all of this was happening, there were a couple of advance rulings which went into a different zone in cross charge. And what those advance rulings said was that if a head office is employing people and those people work for all the branches of the organization, then it means that there is an internally generated service given by the head office to the branches, and that should be mandatorily cross-charged. Now, unluckily, that advance ruling which was issued was in the context of an organization which was providing exempted service, and therefore proviso to Rule 28 was not applicable to that. This created a bit of a confusion. And in the meantime, in various audits and other situations, the department also questioned the non-availability of ISD, non-registration as an ISD, and they started questioning that, look, you shouldn't have done cross-charge, you should have done ISD. All of this was happening, and in 2019, in the 35th GST Council meeting, there was a draft circular which was discussed. And that circular actually was so complex that most of the states objected to that circular, and therefore the draft circular never saw the light of the day. But while all of that was happening, recently there was a couple of court rulings which are coming up. These advance rulings are coming up, and the issue is coming up in a big manner. And therefore, in this GST Council meeting, they thought that we need to clarify or talk about how to deal with this issue. Earlier, they just kept it under the carpet. They said, no, this is too complex. We don't want to deal with it right now. But luckily or unluckily, whichever ways you look at it, this council talks something about it. And that's where we need to understand what essentially are we talking about. Basically, the GST Council meeting tries to say that it firstly tries to clarify the present provisions of the law. It says that as per the present provisions of the law, ISD is not mandatory. And therefore, those who are facing litigation on this point, where the department was saying that you should have done ISD, by doing cross-charge, you are not absolved of doing ISD, etc. All those notices, all those litigations will now become fruitless, and they would be concluded based on this type of a recommendation or a clarification. At the same time, they are saying that even internally generated services, we understand that there is a debate, but they have not clarified in this recommendation what will you do. They are saying we will issue a separate clarification. So they have recognized the problem. For ISD, they have taken a position and clearly said that it is not mandatory. For internally generated services, we are told that we will issue a clarification for the current provisions for the period from 17 till whatever date the change happens. And we'll have to wait for this circular. And accordingly, of course, most of the clients have done a cross charge. And because of the proviso to Rule 28, we do not see a major challenge on the so-called clarification. But as and when it comes, we will also have to analyze that circular and examine that. The point which I'm trying to make here also is that the GST Council also says that there could be a cross charge as well as ISD, or there could be only cross charge. Both those things can be a possibility. But I don't think they are saying that there can be only ISD, because and I'm aware that there are some organizations who are not doing cross charge but only doing ISD. For them, this clarification will be very important, and we'll have to wait for that clarification. And accordingly, even for the past, there can be a bit of an exposure. The recommendation doesn't stop at this. It says that they would also propose an amendment in the law and make ISD mandatory, and that mandatory ISD will be from a prospective date, from a date after the amendment in the law is carried out and notified. So friends, at some point of time, many of us here are not having an ISD registration. The good part of this entire recommendation is that for the past, we don't have to worry. For the current, we don't have to worry. But the bad part of this circular is we are told that in future, you will have to do an ISD. From which date, we really don't know. In my first slide, I've talked about a bit of a fluidity. Maybe, and it may come few months down the line. Maybe it may come from the next financial year. We really don't know. But yes, there is what needs to be understood is that we need to recognize the fact that future is not going to be the same. At some point of time, we will have to obtain an ISD registration. And the cross charge continues. And that's where many of us would have a doubt that what would be ISD and what would be cross charge. And I think that is where we will have to engage with each of you at an individual level, understand or re-understand, because many of us, we did spend time in 2017 to understand and implement cross charge. But now with this changed background, as things develop, we may need to revisit those concepts, and from a prospective date to be notified later, we may need to change our policies. And to do those changes, we need to first understand that yes, at some future date, you will need to do both ISD as well as cross charge. And for that, we need to understand what all things will be ISD and what all things will be cross charge. It can't be that the same thing is both ISD as well as cross charge. And somewhere from the draft circular of 2019, again, I'm sure they would clarify this as time progresses, and we will have a wisdom, more wisdom as time progresses. But just as a fundamental understanding point, we would believe that ISD would cover something which is a centralized procurement of services done by an unit for all other units. For example, your IT department might procure software licenses for all the laptops across the country. Now, if it procures, let's say 1 lakh licenses, and your 10,000 employees are in Tamil Nadu, 5,000 employees are in Karnataka, you have claimed the credit in Maharashtra as a head office, and maybe currently you are doing a cross charge. But here, the services of software license are used. It's not only the benefit going to the Karnataka or Tamil Nadu, but the use of the service itself is by Karnataka or Tamil Nadu. And therefore, this will be a subject matter of ISD, a situation where you could ideally have taken different bills, and let's say you are given 2 orders, one for Tamil Nadu, one for Karnataka, and they would have paid, then they would have claimed the credit. But instead of that, for operational or legal conveniences, you are giving a consolidated order from Maharashtra. So in those types of situations, you will have to do ISD. You can have a scenario where you have a centralized security agency or a centralized housekeeping agency. For all your offices, you have a single housekeeping agency. The people are deputed at each of the states, and the services are rendered and received by those states itself. In those cases, just because the payments are centralized and the contract is centralized, does not entitle you to directly claim the credit. In the future, you will be required to do this through the ISD. That is what we would say is centralized procurement of services. As compared to that, there would be certain cases where the corporate office or some branch office would internally generate a service. And an example which I would give based on the Columbia issue, of course, I have a different view on that, But assuming a conservative view based on Columbia Asia advanced ruling and the Cummins India advanced ruling, let us say there's an HR head sitting in Maharashtra. He necessarily does everything which is required to ensure that the company's employment policies are perfect. And those policies help each of the branches. He takes a policy, he decides the policies for hiring, retirement, the compensation packages, he negotiates a number of things that he does. Now, what Columbia Asia says is this person is deemed to be appointed by Maharashtra, and therefore the Maharashtra unit is giving a service to each of the other units. And therefore the salary of the HR head should become a part of a cross charge, and some value should be defined and should be recovered. And this is something which is known as a branch transfer of service. So this would clearly be a cross charge. Now, therefore, you will have to actually go and identify each activity of your procurement and decide whether it is an example of a centralized procurement of service, which you are doing for everyone, which you could have done by a decentralized manner. And honestly, if possible in your organization, it may be recommended to do decentralization as much as possible to avoid all these types of issues. But I'm aware that yes, it's easily said by a consultant, difficult to implement in practice. To the extent possible, we can do it, should do it, so that at least we have less paperwork on the ISD front. So that's where the difference comes. ISD, where it's basically centralization of decentralized procurement of service, and cross charge, where the head office uses the input or the input service and generates some other service. Now, if that be the case, it becomes a part of the cross charge. So each activity will have to be examined. And then the question which comes is whether you decide on the principle of ISD or cross charge at a macro or at a micro level. In the past, as we are all implemented it, we have done it at a macro level, at entity wise. And most of the cases, we have said that at the entity, we'll do a cross charge. Once we do a cross charge, we identify certain places where a cross charge is required. And accordingly, we have implemented it. We had the cushion of proviso to Rule 28. We had the cushion of the FAQs, which said ISD is optional. We had the cushion of the law itself, which did not provide for a mandatory registration of an ISD. But moving forward, there will be an amendment in the law which will force a mandatory registration. So that comfort goes away. The FAQs will no longer survive. As far as cross charge is concerned, I am fearing that yes, based on the clarification which comes, there might be a little bit of stringent norms on that front as well, or some guidance on that front as well. And therefore, moving forward, entity-wise decision may not work. Can it be GSTN wise? Can it be GL wise? And I'm sure many of you would be thinking that, okay, I'll do one thing. Telephone expenses, I'll take this position. Electricity, I'll take this position. Maintenance, I'll take this position. I don't think even a GL-wise analysis will be the right way to look at it. You might need to go to a micro level of a transaction-wise analysis. And let me give you an example of bank charges. If you look at bank charges, there will be n number of bank charges which the organization will incur. And naturally, you have many of the organizations, they might have 10 GST numbers, but will have only one banking relationship. Now, the bank, three types of activities. One activity would be the bank will help you in collecting your export invoices. And when they collect your export invoices, they will charge you a bank charge for realization of the export proceeds. Now, the bank charges for realization of export proceeds, those exports are at a decentralized level. You might be exporting goods or services from Andhra Pradesh, Gujarat, and Maharashtra. And those bills are sent for realization. Therefore, the service is consumed by those branches. They are never consumed by the head office. This is an example of centralized procurement of service. And therefore, these bank charges will have to go through the ISD route. At the same time, there will be certain bank charges relating to, let's say, financing. You have procured some finance or you need some generic bank guarantee, maybe not related to a project. In that type of a situation, this cannot be a centralized procurement of service because the service of banking is used by the head office, and thereafter it might be giving certain other services and accumulating all of this as a business support for the various branches. In that case, you might need to do those types of transactions into cross charge. Now, at a micro level and at an implementation level, you will find that there is a separate GST registration for ISD and a separate registration for a normal registration. Therefore, in this type of a situation, the bank will have to raise two invoices, one favoring an ISD and one favoring a normal registration. And I am very much doubtful whether this will be feasible. And therefore, this is something which is going to create a big issue. Of course, banking is one example. There will be many examples where you will have to go micro and decide at a transaction level whether you will take an invoice in the ISD registration or you will take an invoice in the normal registration. And interestingly, there can be interdependencies on these facets. And for the interdependencies, one interesting example, technically correct, but I would believe that it complicates fundamentally the entire process, is given in the draft circular of 2019. The question is, when an ISD does a distribution, whether there is a service given by the ISD to the various constituent units. And the answer is yes, there is an activity of raising a tax invoice, ISD invoice, uploading the returns, processing the payment documents from the vendors, etc., etc. And that itself is a service which will have to be valued, and that service will have to be cross-charged to the different branches. Now, therefore, there are some elements of interdependencies which will come in this entire process of ISD versus cross-charge. So, friends, what we see is any implementation of this amendment in a mid-sized organization may take a minimum of 6 months. And therefore, it's important. As of today, there is no panic. We are told status quo will continue. We'll wait for the cross-charge circular for the present provisions. But we need to recognize that amendment is looming in our heads. And that amendment will come. It will take time because the council will propose an amendment. Then there will be an amendment act presented before the parliament. It will be the central law will get amended. Then the state laws will have to amend themselves. And thereafter, a notified date will come. So all of this is a long process from a government side as well. But whenever all of these things happen in steps and in bits and pieces, the last step, after the last step, you might not have a lot of time. They might give you a month or 15 days to implement it. And my experience of 2017 implementation and even subsequent changes which happened is that organizations are always on a time crunch, and 1 or 2 months is too less for implementing a change of this type. And therefore, I think as organizations, it's important for us to recognize that this is something facing us, and therefore revisit the current implementation vis-a-vis the new interpretation as and when it comes up but at least start the process of thinking through these things. Identify the requirements for ISD registrations and gaps in cross-charge if there are any. Obtain those registrations, ISD registrations. If required, we can obtain a couple of months in advance, because once you identify the need for a registration, thereafter, moment you get a registration, you'll have to communicate those ISD registrations to your vendors. And vendors will also have to recognize your new ISD registration. If they keep on giving you invoices in the normal registration, it won't work. And therefore, all of this is an ecosystem and it will take a lot of time. Identify the interdependencies. We talked about those interdependencies. And therefore, it's a long process of around 5 to 6 months, which we will need to keep in mind. As things progress, we plan to connect with you individually to discuss this in detail in the face-to-face meeting, which we are planning in August. We would also be spending a lot of time on this facet. And I think there would be a need for an engagement or an involvement on this aspect so that the correct implementation happens and we don't find surprises a few years down the line. With that, I take you through a few more small changes, and then maybe we wind up in the next 10 minutes or so. The changes are relating to refunds. And as I told you, the earlier one point which we talked about was that refunds would now be available only on the basis of matching of ITC. Of course, we are aware that in Rule 89.4 for exporters of goods, there was a condition of a comparable price. And there was a formula error in terms of numerator denominator. While the numerator was artificially restricted to a particular number, the denominator was very open-ended, and therefore there was a skewed formula. That skew in the formula is being rectified. We are told under Rule 96A that if export of goods does not happen within 3 months from the date of removal of goods, or if export of services are not realized within 1 year, then you are required to pay the amount of tax. Now, and then we are told that when you receive it back, you will get refund, but there was not enough clarity on how to process that refund and what are the steps in that regard. So we are expecting a clarification in that regard. And finally, and this is something which might have a widespread implication, is that a couple of years back, we amended IGST Act Section 16. As you are aware, Section 16 permits you to export goods or services by two methods. One is LUT and one is a rebate route, the customs route. And of course, even in services, you can export either on payment of tax or on accumulated on non-payment of tax with a refund of accumulated credit. So refund and rebate are the two routes which are right now permitted under Section 16. The law was amended to say that now the LUT will be the default route, and export rebate will be permissible in certain cases. That was never notified. Now, the GST Council has decided that we will notify this with effect from 1/10/2023. And then they have also said that we will not allow export rebate route in certain cases. So if you are using the export rebate route, and I'm aware that those cases are very specific, tobacco products, etc. So maybe it will not impact you immediately, but it's important if you are going by the export rebate route, you might need to keep an eye on these notifications. And if it impacts you, then maybe you might need to amend your transaction structures accordingly. Finally, some procedural changes. GST Appellate Tribunal, 6 years we have been talking. Finally, we are seeing some action. The Appellate Tribunal appointment rules are being prescribed. So now you will have, the members, the president, all of them getting appointed over a period of time. And as time progresses, maybe, though the movement is a bit slow, at some point of time, there we will see things happening in this case. We are expecting a clarification on who is going to pay TCS in case of multiple e-commerce operators. The next one is interesting. And again, this is something which started creating a difficulty in case of online information service providers and e-commerce operators, especially when they had B2C transactions, and most of these transactions happen online. They may not have an address of the recipient, and therefore they typically used to use the benefit of Section 12 residuary rule, which said that if you do not have the address of the recipient, the place of supply will be the location of the supplier. So what was happening was, for examples of e-commerce GST or OIDAR GST, a lot of tax was getting concentrated in the state where the e-commerce or the OIDAR was located, and was not flowing to the actual consuming state. The consumer may be located, let's say, in Andhra Pradesh, but if the e-commerce operator is in Maharashtra, the Maharashtra guy would pay the GST in Maharashtra itself, even though the taxes, the payment of the basic value and the consumption of the service is happening in in Andhra Pradesh. Now, therefore, last year there was a circular through which an obligation was cast on such e-commerce operators to mention the address on the document and keep a record of the address. And based on the address available, they were expected to discharge the GST as IGST and plot the place of supply. Now, many of these examples, the value is immaterial. Also, the payments are made online, and therefore there is no mechanism to identify the address or the correctness of the address. And end consumer, many a times when he sees too many fields, he might just put in some junk. So there's no mechanism to really revalidate it. So therefore, a clarification now is given that you may not have a detailed address of the recipient. You may merely mention the state of the supply. So you might, in your portal, might have a drop down which says that these are the 30 states, and you please select one. As a consumer, you please select one of the states, and accordingly you proceed. So that relaxation has been given. The next is a clarification which says that an e-invoice will be required for B2G transactions where government department has a TDS registration. I would believe that was the initial interpretation as well, but that has been sought to be clarified. Manual filing of appeals is now permitted, especially in cases where Tran-1 appeals are there, and or if the officer has issued an online order offline and there are some technical glitches on the portal, then manual filing of appeals will be permitted in those types of situations. And the next is slightly worrisome, because as of now, the e-way bill requirements are not applicable for gold and precious stone movements. And there's a reason behind it, because there is, at times, there is a risk of confidentiality issues coming up, and gold and precious stones are amenable to theft and risk. And therefore, consciously, we have tried to avoid the requirement of e-way bills for these types of movements. But now certain states had some concerns on this front and they felt that there is an evasion of tax. And therefore, what we are told is a particular state, if they want to prescribe an e-way bill requirement for these movements, for intrastate movement of these goods, they can do so. Interstate movements would still not require an e-way bill. But for if let's say tomorrow Chhattisgarh says that I want to prescribe a e-way bill requirement, then intrastate movements of gold or precious stones in the state of Chhattisgarh would require an e-way bill in that situation. So that enabling provision is thought to be brought in. And finally, registration process is thought to be strengthened. We are told that the bank account will have to be validated and put. Other authentication, we talked about it in the past. And in certain cases, there might be a physical verification of the premises where they see a risk of evasion or things like that happening. So that is all from my side. A lot of changes have been implemented through the GST Council meeting. A lot of them, as I said, are good, but on an average, I would believe that it's also a mixed bag. Some good points, some bad points, and a lot of things for us to take home, especially from the concept of ISD versus cross charge. And I'm sure many of us would have some doubts on that front. We would wait for the clarifications. We will be in touch with you. And maybe in the next interaction, which may perhaps be a face-to-face or a webinar, we will have more detailed clarity on that front and more actionable points for each of you. But till that time, maybe these are pointers for you to think through. Maybe as and when we meet or through discussions on the phone or personal meetings, we can on a one-to-one basis discuss the exact implementation and the strategy for each of your organizations. I think I've taken a lot of time and I think I would wind up with this. Thank you very much for patient hearing. And this session is also available on YouTube. And those of you who or your colleagues who have not been able to see this can always go back to the recorded version and watch it on the YouTube as well. Signing off. Thank you very much. And we'll meet soon.